Every Perp Dex advertisement leads with the same number, up to 100x, sometimes up to 200x. The leverage ceiling is the first thing you see, the first thing platforms compete on, and the first thing most traders use to filter their options. It's also one of the least meaningful numbers you can look at. Today, I want to make the case for what actually matters, and why the traders who figure this out consistently outperform the ones who don't. Let me start with what leverage actually does. Leverage multiplies your exposure to price movement. That part is simple and well understood. What gets less attention is that leverage multiplies every cost underneath the trade at exactly the same rate. At 50x leverage, a 0.1% spread costs you 5% of your position value. A 10 basis point Oracle staleness gap, the difference between the price your platform thinks is live and the actual market price at that moment, also costs you 5%. Funding drag that runs at 0.05% per 8 hours compounds into something material over a multi-day hold. A liquidation engine that fires 0.3% too early, because its pricing reference is stale, closes a position that would have survived. None of these numbers appear in the leverage headline. They show up in your P&L. Let me go through the costs that the headline doesn't show. First, Oracle staleness. When you open or close a position, the price used to execute your trade comes from a price feed. If that feed is running behind the actual market, there is a gap between the price you expect and the price you get. At low leverage, this gap is a rounding error. At high leverage, it becomes a recurring, invisible tax on every trade. The math. If your Oracle feed has 1.6 seconds of average staleness in a market that moves 10 basis points per second, you're entering each trade with roughly 16 basis points of structural disadvantage baked in before any spread or fee. At 50x leverage, that 16 basis points is 8% of your position value per round trip. Not a transaction cost, not a fee, just stale pricing, silently working against you. Second, funding rate drag. High leverage directional positions held over time accumulate funding costs that scale with position size. This is well understood in theory and routinely ignored in practice. At 50x leverage, a funding rate that seems small, 0.03% per 8 hours, annualizes to over 30%. If sentiment stays aligned against your side, this is a persistent drain. The leverage number did nothing to disclose that. Third, liquidation mechanics. Liquidation engines depend on the same price feeds that execute trades. A stale price feed means liquidation checks are running against outdated data. The result is positions getting closed slightly too early because the engine sees a price that's worse than reality, or slightly too late, creating bad debt in the system. At normal leverage, these errors are minor. At high leverage, the margin for error is narrow enough that a 1% stale price and a 0% stale price can be the difference between a live position and a closed one. Now let me run a comparison that actually matters. Two traders, same directional view, same asset. Trader A uses 50x leverage on a platform with 1.6 second average Oracle staleness and a liquidation engine running off that same stale feed. Trader B uses 25x leverage on a platform where the Oracle feed averages 0.086 seconds of staleness, close enough to real time that structural pricing gaps are largely removed from the equation. Trader A has the headline advantage. In theory, they make more money per price point. In practice, they're absorbing hidden slippage on every entry and exit, running a liquidation engine that fires against stale data, and paying a funding rate calibrated to the platform's LP incentive structure. Trader B is giving up 25x of theoretical upside, but is getting executed against a price that closely reflects the actual market at the moment the trade happens. Their liquidation engine sees real-time data. Their funding rate tracks actual trader positioning. Which trader performs better over a large number of trades? Not obviously trader A, and that gap widens as markets get more volatile, which is exactly when traders want to be at high leverage. Execution quality is how close your executed price is to the true market price at the time of execution. It's a function of oracle freshness, settlement latency, and how risk mechanics are wired together beneath the trading interface. A high-quality execution environment keeps these gaps small. A low-quality one lets them accumulate, quietly, at the rate of your leverage multiple. This is the actual competition among perp dexes, not the leverage ceiling, the infrastructure under it. LeverUp's infrastructure decisions are execution quality decisions. Pyth Pro reduced Oracle feed staleness from 1.676 seconds to 0.086 seconds, a 19.5x improvement measured across 370 parallel samples on Monad Mainnet. Protocol-managed settlement means execution and risk management are handled at the protocol layer with deterministic mechanics, not LP-side variability. The leverage range available on LeverUp is what it is. What matters more is whether that leverage is delivered with execution infrastructure that doesn't silently work against you. For the full data on Oracle freshness improvement, the Pyth Pro upgrade announcement is in the show notes. And for a deep look at how Oracle staleness specifically creates hidden slippage costs, the P1 article on Oracle freshness as hidden slippage covers that in detail. As always, not financial advice. See you in the next one.